Thanks, Steve. Great to be back. It's been a couple years since I've been in Singapore, so it's good to be here. The airlines were a little bit more friendly this year than they were last year, so I was able to make it here. I'll see all of our traditional underwriter friends kind of exit as we get into some of the discussions around cat bonds. But Mark, thank you for calling brokers your friend. I really appreciate that acknowledgement. Okay, so more seriously, we want to talk about a couple things today, really kind of level set around the industry. I know there's a good mix of folks in the room, and so you all will have a slightly different perspective. We want to talk about sort of ILS, and we will benchmark everything against cat bonds. And so you might say, why do we keep talking about cat bonds? Cat bonds are relatively public, so there's a lot of good information. But it's also the baseline on which everything that's done in ILS is compared to. So as we start to grow out product capability, which is especially relevant here, the whole conversation around product or sort of coverage gap, protection gap, different products will sort of solve that, embracing technology. But everything will be compared against how cat bonds trade in the market, how cat bonds are priced, et cetera. So we'll lean heavily into the cat bond market. We'll talk about lessons learned a little bit. Some of the comments from the prior session talked about just the difference a year makes in the market. Well, ILS brings multi-year capacity, which takes away some of that volatility. And we'll talk about sort of, the puts and takes around some of that. Strategic importance of ILS, just generally speaking, and then opportunities for growth, because I know that's really the objective that Steve wanted to cover here, which is how do we grow in Asia. Okay, so as we look at the past 10 years, at least from Aon's perspective, and we size up the penetration of ILS into reinsurance, you can see the top row really is a percentage of what we'll call ILS or alternative capital as a percentage of sort of the total reinsurance capital. And you can see that's actually been relatively stable over the past 10 years, kind of trending upward. And what I will say is that stability is kind of evident even in markets where you see kind of pullback in traditional capacity, right? So, we'll call it the Great Reset of inflationary pressures, of financial market volatility, of kind of losses coming through the market. That obviously was very challenging for traditional rated balance sheets. ILS continued to, I think, trade well in that marketplace and offers those that looking to transfer risk a little bit more stability than what comes from traditional markets, which is very reactionary to kind of what's happening just generally in the marketplace. But very stable, and I think the outlook for this market is going to continue to be stable. And 15% of total capital today, it's even sort of more important in the property sector, right? So this is all reinsurance capital, so all the capital reinsurers use to support all the risks. But when you boil down to just property, the 15%, is far more significant than what shows on paper. Over the past 12 months, we've seen a change of mix in kind of what we'll call ILS or alternative capacity with a very much a focus on cat bonds. And that's driven in part by the allocators to the space. So might want to throw ILWs in here as well. So cat bonds and ILWs seem to be a little bit of the product that's in vogue today, in part to kind of where those products sit in the reinsurance tower. But when you just do some simple comparisons the past year to the prior 5 years, you're going to see a very stark difference in the growth rate. We expect kind of the product mix that's in vogue today to continue for the recent or for the next few years at least, just given where investor or allocator preferences sit today. So again, not to say that collateralized reinsurance products aren't important. They obviously are. But when you think about kind of where investors want to deploy their capital, it's much more aligned with kind of the cat bond world today than it has been in the past, which really takes us back 25 years or so ago when the markets were founded. Okay, so some of that record-breaking characteristics are shown on this slide. So you can see that 2023 was a record-breaking year, a record-setting year in terms of issuance. I would be shocked if we don't exceed that this year. And when you look at some of the contributing factors to that on the bottom left of this slide, you're going to see more clients issuing. You're going to see larger sort of transaction sizes as capacities have been very plentiful this year. Structures are continuing to innovate. Hopefully that will solve some of the protection gap issues that were talked about earlier. We are heavy US, and we'll talk about some of those percentages as we move forward. But I guess very important part of this market is the discipline we've seen from the ILS investors, or really not only the fund managers, but the allocators to the space, kind of demanding that there's discipline in this space. So we'll have a very interesting kind of 1-1 if we go a light cat year. We'll have a lot of capacity just across all of the marketplaces, traditional ILS. And so we'll see kind of how that discipline sort of manifests itself as we go through this year. But that's a very key component to kind of what that great reset did in the marketplace. So you saw greater demand coming from inflationary pressures. You saw greater discipline in terms of return expectations, and kind of all of that has created a very sort of favorable market for issuers, and we would say not only U.S. issuers, but also in this part of the world. Okay, and then what you look at today is as we break out what we estimate to be 110 billion of alternative capital, you can see the percentage of bonds at 46 billion of that 110. So that is the highest it's been in a very long time. So roughly 40% of the marketplace, still driven largely by U.S. exposures. But when we look at the global issuers, when we look at the aggregate amount of notional limit put into the marketplace, those are all pretty staggering numbers over the past 25 years. And by the way, there's not a lot of people that can say they've been here for 25 years, but I am certainly one of those. And we've seen just a very interesting market develop, and we've moved out of sort of a novel asset class into a very sustainable, durable asset class, and we certainly expect that to continue. Where the market likes to deploy capital, though, is not going to be everything for everybody. So we see a 2 to 3% expected loss. That's sort of the average of where the market wants to deploy itself. We can do higher, we can do lower, but as we continue to sort of drive these products forward, as we think about new products, it will be important to expand that, at least the breadth of what is possible to be done in the market. Okay, so U.S. being 82% of the market, that in itself isn't a problem for this part of the world. In fact, I think it actually helps. It helps this part of the world bring risk into the marketplace. And what we'd like to see is that U.S. or North America component probably come down to someplace in the 70s and allow room for other parts of the world to take its place. And when you look at the APAC limit on the right-hand side of the slide, for several years, we were at greater than 10% of the entire market outstanding, and today we're basically half of that. So, the growth in issuance has obviously been a little bit of a negative to that particular ratio, but just lack of keeping up with just the general trends in the marketplace that has driven that lower. So there is opportunity here. What we can say is that the diversifying nature of the risk from a portfolio construction perspective from Asia, from Europe, are very appealing to investors. And so part of what we'll talk about in a bit is changing the mindset. I know some of the prior conversation was simply around price. We have to sort of change that mindset to be, let's place traditional capacity in this marketplace, and oh, by the way, if we can't get something done or we can get something cheaper in the ILS market done, then we'll go there. I think what we need to do, what we've done in the US, is say, let's take a look at ILS first, then figure out how to optimize the overall risk transfer strategy once we've determined what can be done favorably, strategically in the ILS market. Okay, moving away a little bit from cat bonds, the other thing we've seen over the past 18 months is a kind of a resurgence of sidecar capacity. There are investors that have come back to the table really mainly opportunistically. So as we've seen kind of a change in premium levels, change in return levels, we've seen very significant pickup over the past 18 months, to the tune of $1 billion of new capital entering the sidecar market. We think this is sustainable as long as we keep the return dynamics kind of similar to the way they are in this marketplace. So sidecars offer, reinsurers a very efficient way to transfer risk, to partner with investors to transfer risk. We expect these to continue mostly from reinsurers, although I will say we are working on insurer sidecars as well. Those are just a little bit more challenging in terms of generating the types of returns investors want to see. Okay, so the puts and takes. I'm not going to spend too much time on this. I think everyone intuitively understands this, but we are subject to the puts and takes in this market, just like reinsurers are. So we'll see kind of the classic supply-demand characteristics kind of shape the views of this marketplace. Again, won't sort of read all of those, but again, post the Great Reset, we've seen a lot of these factors come into play. A little bit less so in terms of the inflationary impact here in Asia, a little bit more in the Pacific, but that's obviously been a big driver where demand for reinsurance in the U.S., as an example, has exceeded the supply of reinsurance, at least until mid-year this year. But there are a number of sort of puts and takes. As always, we are not immune to those cycles. We will continue to have those cycles in this marketplace, and important just to understand what they are. Okay, so hopefully you can see this. I think this is kind of an interesting slide. So what we've done here is try to talk about the 2023 markets, compare that to the 2024 market in terms of change. And we've highlighted really the Asian and Pacific markets. And so you'll see, if we just use Japan as the example, you can look at those numbers. I think the point here is that 2023 saw material change upward in terms of premium levels. And while we might be flat and maybe even giving back some of that in 24, from a historical perspective, it's still very interesting to the ILS market. And so we're starting at elevated levels, even if we continue to sort of whittle that back a little bit. I think that the most challenging part of this isn't sort of the rate change. The rate change is what it is. It's going to, again, reflect the supply-demand issues that we've seen in the market. The bottom line of demand is the issue, right? So we're seeing flat demand out of this marketplace over the past 2 years. In Asia, we're seeing a little bit more of that demand in the Pacific, probably in part due to some inflationary factors. But that demand issue is really where I think this market has to focus on. How do we increase the insurance penetration ultimately, but then having the lag of the reinsurance sort of following that increase of the penetration of the primary product. So they're embracing all the things that have been talked about to date. In this forum are going to be important: developing technology, developing product, increasing that penetration, knowledge, and et cetera. But until that demand line starts to increase, I think it's going to be challenging to really move the market in terms of the penetration of ILS into Asia. Although, as I said, if we just have a simple mindset change of looking at ILS first and then structuring the entire risk transfer program sort of following that, I think that in itself will lead to more opportunity. Okay, so when we think about some of the Asia and Pacific marketplace, we've tried to put in here, some of the ways of looking at this in the past. Some of these comments have already been mentioned, so I won't necessarily read all of those. But again, if everything is going to be compared to price, and I know this market is extraordinarily price sensitive and budget driven, that is in itself going to be a constraining factor. And so I think what we need to do is build in the strategic benefits of ILS, talk about how ILS can adapt to support the Asian market as opposed to trying to fit what's done elsewhere in the world into Asia. I think we can be innovative around smaller structures. We can create opportunities for clients to transfer risks that are smaller, kind of proof of concept, and then once those are successful, we can build those into larger, more scalable programs for Asian companies looking to transfer risk. And so the modeling will follow, right? I think there's a lot of smart people around the modeling, and some you've heard from today. I think the modeling will sort of keep up with the pace of risk transfer, and starting small, kind of looking at even sort of historical data as a way to drive transactions, and then sort of build that into sort of a modeled view over time. I think there's a lot of things investors will ultimately accept if we can bring the issuers to the table. Regulatory considerations are obviously important. Singapore is, we're very pro Singapore. We're very pro Hong Kong. To the extent that is an enabler of business, that's fantastic. If not, there are lots of jurisdictions around the world that are sort of available. I don't think that's in our experience that hasn't been a detriment to transactional issuance over here in this part of the world. But I know there is some benefit of trading locally, and so we would certainly urge everybody to sort of follow on with that. Okay, so this is a slide I particularly like, at least from Aon's perspective. So as we look at the last several years, I think there's 7 years here, basically we've doubled the amount of clients that have cat bonds in their program globally, since 2016. So this is something that we are very proud of as an industry. If you were to take a look at this regionally, we did the math over lunch, you'd have similar sort of quantum. So we basically be doubling the size of, or the contribution from Asian and Pacific, taken as a whole, clients since 2016. So the doubling of the client base, over this period of time, I think is very interesting and really talks to the sustainability of these types of products. On the right, we've tried to outline some of the benefits. Again, they've been talked about historically, they've probably been talked about today, but clearly the last point of this, I think, has been lagging in Asia, right? So the strategic value of ILS, I think, there's been less importance put on that particular aspect in Asia, more on sort of the second point of competitive pricing. We do understand that that's important, but I think there's some strategic benefits for clients that have been largely, or at least have not been, the weight has not been put on that potentially that should have been. And this may be the last slide, I'm not sure, but what we tried to do here is highlight how it's labeled illustrative, but it is reflective of an actual company. We've tried to highlight how a company that's a very active issuer in the marketplace use this particular marketplace. And so you can see that over each year, there's some amount of limit issued. By the way, when you compare the amount of cat bond capacity to the traditional program, it equates to about 20% of their risk transfer product being put into the cat bond market. There are some benefits of issuing each and every year as opposed to issuing one transaction and then coming back to it when it matures 3 or 4 years later. There are some benefits over minimizing volatility, et cetera, that you just get through a more frequent approach to this. And by the way, there's mechanisms now to issue smaller transactions. So part of the issue in the past has been, well, we don't have $100 million or something equivalent to issue every year. Now there are certainly ways of, somebody mentioned frictional costs, there are certainly ways of bringing those frictional costs down, issuing as small amounts as $25 million a year. Again, hopefully that will scale up over time, but there are certainly ways to be able to do that in this marketplace. So in the US, it's not uncommon to see the large buyers of reinsurance have as much as 20% of their program put into cat bonds. Obviously, we're nowhere near that, even in Japan, which is the largest issuer in Asia. But as we think about penetration into other Asian markets, I think there are lessons learned from the US that can be adapted to Asia. I think that just will help the growth story. And then lastly, as we think about the investment thesis, and I'm sure you've heard this from all the managers today, we think we're actually in a pretty good place to attract new capital into this market. We saw very strong returns in 23. Fingers are crossed as we go through the North Atlantic hurricane season in 24. We'll see how that shapes up. Non-correlation continues to prove out. We are seeing assets come into this space from Asian-based investors, pension funds and sovereigns being the large drivers, but more and more high net worth investor flows in as well. And so, we estimate that somewhere between 5 and 10% of the overall marketplace coming from Asian sources. So we're generally bullish across kind of all markets for raising capital, certainly here in Asia as well. Oh, last slide now. So, a lot of our conversations have been around property. There's been some conversation around cyber. Obviously, we heard more about that today than we have in the past. Cyber, we're excited about, and we think that is a potential growth area sort of globally. We'll see how that develops over the next couple of years. But we would certainly like to see a run rate in cat bonds from cyber of $500 million a year, moving up to $1 billion in a couple of years, and really sort of proving that out. The parametric opportunity is huge. I know, speaking for Aon, we're very excited about parametric, not only in the ILS market, but also in the rated markets. And so we now have a sort of a global approach to parametric across the Aon platform, and really excited about how to build that out. Public sector, you'll hear from Michael next. We're excited about where this market can go. We think there's a lot of untapped opportunity as we talk about the benefits of ILS for cultures and for countries, and making those more durable and sustainable. And I think we're just sort of scratching the surface of what can be done there. And lastly, casualty. So casualty is coming. There's obviously been a couple of transactions around casualty. We think more and more time will be spent on casualty going forward, and really excited about sort of that opportunity as we move forward. So I think all of these are particularly relevant for conversations in Asia, but just generally we'll see these as really the growth drivers for ILS, at least some of the growth drivers for ILS as we move forward. That's it.
Thank you, Paul. Very pleased you spoke about sort of strategic buying and how that's changed over the years, because that's something that I find really interesting, is particularly how we've seen US buying seems to have changed in the last year or two, really, I think, for some of the cedants. And ILS first certainly has become a way of looking at risk transfer that certainly wasn't the case 5 years ago. And that's changed fairly quickly. What do you feel maybe has driven that change in the United States?
So it is interesting, because I think if you go back 20 years ago, we were probably no different than what was happening here, which is simply putting up ILS quotes next to traditional quotes, and then client typically choosing the lower of those to move forward. And so that's typically what happens here, today. But as companies have, as they've grown their purchasing, as there's been consolidation, there is very significant traction for multi-year capacity, collateralized capacity, and just kind of all the benefits that we talk about here. And I think people have bought into that. And so, the fact that if there's a significant event happening, or there are multiple significant events happening across the world, having collateralized capacity at the top of your program, helps people sleep at night. And so I think you get down to some of the basics here, and when you get into what are the attributes, or what are sort of the values that this market can bring, it's simply more than price. And too often we're just shopping price.
Yeah, and it's interesting that we've got sort of a new generation of cedents as well coming through. Thinking people like Sageshore, obviously, who've been quite prolific in the last just year and a half. Do you think that bodes well for others watching that sort of example, and perhaps newer companies accessing ILS much faster than companies used to in the past? In the past, companies were around for decades, and then suddenly they'd venture into ILS.
Yeah, I think the fact that the ILS markets are really the fund managers, some being represented here today, are willing to take a look at these newer companies, or even kind of non-insurance or reinsurance companies in terms of risk transfer. I think that willingness to look at those type of exposures in a constructive way will continue to bring more issuers into the marketplace. And I can say, at least from our firm's perspective, we are sort of busier than we ever have been on more sort of non-traditional sources of risk coming into the marketplace. And so we're very excited, and the parametric piece really has us really sort of jazzed up for the future. So we're excited about what that can bring in terms of the protection gap, and just allowing risk to be transferred in the market in a different way, and providing some benefits there. So I think all good in terms of the next several years in terms of growth.
Yeah, and that's all on the obviously the demand side, and one of your slides showed that demand's rising in most areas around the world, but flat in Asia still. Do you have any sort of, what's your gut feel as for what's held that back a little bit the last few years?
Well, I think to some degree there's been, certainly, ILS views, Asian risks as positive for portfolio construction. Reinsurers view it the same way, right? So having, a spread of risk into the reinsurance portfolio is equally as valuable to reinsurers as it is to the ILS market. And so the value of diversifiers is important. We've seen kind of a reversal of the capacity in the marketplace. So all of a sudden now there's excess capacity in the marketplace. And so that means some of the alternatives are less looked upon. And then quite frankly, in some markets, we're seeing less buying. And I think there was some reference to that earlier, where, even though there's been some penetration, the retention levels are, increasing. And so there's actually less risk transferred into the marketplace. And by the way, again, Aon, we're supportive of every market, and obviously the bulk of what we do is into the traditional markets. Relationships are important. And so when you think about, a cedent trading with a reinsurer for 50 years, you can't discount the importance of that, in the decision-making process. I will say that the ILS market is moving more towards a relationship-based trading mentality. And so, I think if you go back 15 years, it was very transactional. And by the way, there still is a transactional component to it. But as we have the fund managers growing in their scale, as they're successful in raising assets, the value of continuing those relationships is more important to those managers as well. And so the relationship aspect is becoming more significant, which will in itself lead to greater opportunities in the future.
Yeah, that's a great point. And actually, it's been really pleasing to see the way managers have actually started to help educate cedents, really. The job that was often the job of the brokers, but actually the ILS managers are doing a really good job there of sort of furthering this sort of strategic rationale behind ILS as well. Moving to a different area of the market. So we've spoken a lot about the cat bond market. but the collateralized side obviously has had a slightly more difficult time over the last 5-6 years. But there are some signs of green shoots emerging, I hear, and certainly the discussions I have with people in the market and investors is that they're looking more favorably at it and they're feeling like it might be the time to start deploying, but there does seem to be a bit of nerves about the potential for a soft market again. So what's your feeling? I mean, what are you hearing at Aon? Are you seeing collateralized limits that aren't in cat bond form increasing? I know the sidecar side was one area, but
I'd say certainly on the retro side, we're seeing new capital come in to support retro opportunities, and that's obviously very positive for lots of reasons, right? That creates more capacity for reinsurers, creates more capacity for ultimate, insurers transferring risk into the reinsurance marketplace. So we've certainly seen a little bit more retro capacity come in. On the collateralized reinsurance side, I still feel like we're seeing at the margin more capital go to bonds and ILWs than we are to collateralized re. From a portfolio construction perspective, it is helpful to have collateralized re products fill in the types of capacity that doesn't come through the bond market as an example. And so we're seeing, that, clearly be something that's utilized. What I would say from a cedent's perspective, though, collateralized re behaves in the same way as reinsurance. So, many times it's fronted through a party, many times it follows the terms set by reinsurers. And so part of the diversification you get from the bond product is a behavioral diversification. You don't get that with collateralized re. Collateralized re simply means whatever the reinsurance market does, collateralized re is going to follow. And so, yes, that is appealing, but I think part of the value to the cedent is having capital behave differently. So not just a diversification of your capital sources, but a diversification of the way it behaves. And I think that's probably a part of the diversification story that hasn't been talked about enough, but as the large U.S. cedents have looked at this, I think that is something they have grown to appreciate over time.
Yeah. Wondering on the investor side, obviously we've been through a hard market, exceptional returns last year for ILS, but do you think investors are cognizant enough of the improvements in terms that have been made as well and the structural improvements that have been made? Because it does feel to me that the benefits go far beyond the returns at the moment. The market is in a much more robust place and with much more favorable terms and attachments.
Yeah, I think our friends on the management side have done a pretty good job of educating the allocators. But the fact that attachment points for so many years didn't change regardless of what the exposure may have done over that period of time. I think now that we've seen maybe the second layers are now the first layers, I think that is much more impactful than premium changing a couple percent one way or the other. So I think that will help the prior conversation on collateralized re as you sort of take some of that volatility away from being transferred and it's retained. I also think it's helpful for the insurers to retain that. There are some obviously capital issues associated with that, but I think that leads to a greater sustainability of the primary business, being transferred to the reinsurers or to the ILS market, and simply not just passing along everything regardless of kind of what the performance of that is. So I think that leads to a much more healthy insurance and reinsurance market and trading market over time. So just increasing the attachment point for where risk transfer starts, I think is very significant. My guess is that as capacity starts to come back into the marketplace, some of those terms, other terms may change a bit, but if we can keep the attachment points where they are, I think that actually from a structural perspective is very impactful.
Yeah, seems very helpful. One of the topics I wanted to touch on with you was the recent Puerto Rico parametric re cat bond, because to an outsider looking in, it seems very important that a government of a US territory has purchased catastrophe bond backed risk transfer directly as well, without any sort of intermediating parties apart from obviously the structure itself. And what are your thoughts for what that could potentially mean or provide as an example to other US entities, municipalities, local governments, federal government?
Yeah, as I said earlier, part of our growth, part of our growth story is the public sector, and I think the World Bank has done a very fine job in developing that. But we see a lot more opportunity around that, and the value is clearly getting money into those loss-affected areas as quickly as possible, and the parametric structure is actually an enabler of that. Now, there is basis risk, and so it's important that education is there for events that come close to attaching but don't, or maybe some view that should that don't. And so there is some education involved. The selling process is actually a little bit longer because of that, because there has to be those conversations. There has to be making sure that everyone understands what that is. But there is true value in having cash in the constituents' hands, within a few weeks of the event happening. And I think to the extent that, we can use what the World Bank has been doing, and we can use kind of this example in Puerto Rico to sort of, get others interested. I think that's certainly something we'll be focused on. I do personally think it's very helpful for parts of the world, parts of the global economy that just don't have some of the resources available that others do. And so I think it's extraordinarily helpful.
Yeah, and it's interesting that we've also even seen that recognition within an investment group recently as well, with Gallatin Point buying a cat bond to hedge out some of the cat risk that's within their private equity investments in the insurance space, which is another interesting use case that's emerged. So we've got a number of local investors in the audience, and people from asset managers and things. And I was wondering, sort of, if people are considering their first allocations to the asset class, how do you talk to them? What do you say, and how do you sort of help them understand the opportunity set?
Yeah, well, I think we're somewhat privileged at Aon because we have a lot of resources at our disposal that we can bring in, but we really focus on education first. So we try and talk about just what has happened, kind of what the dynamics in the marketplace look like, and then how to think about what may happen in the future. Clearly, the non-correlation piece of it is a very important component of why folks do this. But we try and move away from what has been a black box conversation into something that's a bit more tangible in terms of just understanding the dynamics of what happens in the marketplace, and trying to talk about the way that risk comes into the portfolios, the way that sets up for potential drawdowns, things that are very important to the investors in the marketplace. But it's really a lot of conversation around, education first, and then, talking about opportunities. But, these days there are all kinds of means for investors to allocate capital into the space. Not all are the same, and I think we can really dial in for the risk return that, an allocator is looking for. There are certainly products that fit that, and it's not just saying we have a general fund that you can invest in. I think we can be very bespoke in terms of the opportunities we create.
Good. I guess final question from me, and then we'll turn to the audience. Do you think 20 billion is within sight this year? It's the number that everybody's been talking about.
Yeah, certainly. We'll need a positive. We'll need a very positive sort of second half of the year. We've all come out of the first half. We're happy to catch our breath here for a few weeks, but we're clearly working on the pipeline for the second half of the year. Some of it will depend on just the whether this is a light cat year or whether this is a heavy cat year, and I think you get deviations of sort of that number based on kind of what they are, but retained earnings within the reinsurance industry will be quite strong if it's a light cat year, and so the dynamics going into 1/1 will be quite different in terms of the capacity. We already saw that in terms of the mid-year renewals, where there was excess capacity, reinsurance capacity in the marketplace. And clearly that type of dynamic would continue as we get, closer to 1/1. And so, the concept of discipline, the concept of utilizing, capital well for your constituents or your shareholders, whatever form you're in, whether you're in a rated balance sheet or ILS, I think that will be the focus for, kind of what the end of the year looks like. But the reset that we went through in terms of just, kind of hitting a lot of different things was very constructive. Investors need to earn an adequate return to be able to continue to allocate to the space. Same would be true for reinsurers. They need to earn an adequate return for continuing to make their capacity available. But I think we will likely have the supply-demand factors come into 1/1 if we go light cat or largely loss-free for the rest of the year.
Yeah. We mustn't forget that there'll also be retained earnings in cat bond funds and
oh, for sure,
$3.5 billion in maturities coming as well. So should be an interesting end of the year when we get through the hurricane season. So let's see if anybody in the audience has got a question for Paul. Please raise your hands if you do.
Hi, Paul. Nathan Lord from Java Capital Management. Quick question. You described a difference in behavioral patterns between reinsurers and fund managers. If you could elaborate on that a touch and also describe any changes that you may have seen given the development of relationships between the more established funds and the cedents.
Yeah, so let's start with the second question. Is a little bit easier to answer than the first one. But so, clearly if you're a large asset manager, if you're a large sort of, fund manager in the space, you have capital that needs to be redeployed, on an annual basis. And so there's a lot of incentive to finding those, cedents that are looking to transfer risk on a regular basis and growing those relationships as opposed to finding new cedents every year to kind of redeploy your capital. And so it's a way of in a way kind of following or copying the reinsurance model in terms of talking about the types of things that are important for the fund from the fund manager's perspective to the cedents, in terms of what's important to continue those relationships, where can a cedent think about growth, how should they think about different risks and different perils. And so those conversations are all very constructive, and we're having a lot more of those as opposed to simply putting a deal into the marketplace, getting folks to subscribe to that deal or not, and then moving on to the next year. So the amount of touch points that are happening over the course of the year has increased meaningfully. And it's really in a way to make sure that the fund manager gets across its perspective about what's important, but then also listen to the clients or the cedents about things that they might want to do in the future. And so it's mainly about aligning expectations and then having more confidence to be able to redeploy or continuing those deployments moving forward. In terms of the first point about diversification, cat bonds just behave a little bit differently than collateralized REIT. First of all, they're multi-year, and so you have a little bit of different sort of durability, I guess, if that's the right word, into the product structure versus an annually renewable transaction. And so you just get slightly different behavior. And I would say that, largely cat bonds have tighter terms and conditions than traditional reinsurance contracts do. And that's on purpose to avoid sort of any ambiguity around loss events. But when you look at sort of all of those things put together, it just behaves a little bit differently. The buying process is different. The maturity period is different. And the way that fund managers behave around bond products versus collateralized REIT is a bit different because of all of those factors.
Time for one final question. Mark.
I would have been disappointed if Mark didn't ask a question.
Paul, just a quick one on your comment regarding 1.7, that we happen to see quite a fair bit of excess capital. That in itself does not necessarily imply that we can have it easily, or buyers can have it. I mean, from my experience, at least for a bit of time, in particular also at 1.7, yes, I realized also there was a fair bit of excess capital, but I think it was sold with caution. So which means if you compare this with a couple of years ago, excess capital was quickly sold. Now, my observation is in many parts of this world, it is not that quickly sold, but it's there. So we don't have this significant dent which we saw maybe a year or 2 years ago. And the other thing is, I entirely agree with you, 2024 will be very crucial in terms of cat pricing, because we had like 2023, fortunately a very good year, but in many parts, like in particular also in Asia, we needed that. Because if you look at those companies who have been, for instance, prominently in the active in the Asian cat markets for 3 years in a row, before 23, they didn't make any money. So it's really important also to fill up our own banks, and on a worldwide basis, I think if the US and Europe are coming up at the end of this year with, I would say, an below expectation sort of cat activity, then probably we will see at least not really anything going north anymore. But if it will be as many expect that it's quite active, then I would say we shouldn't be surprised if prices are going up further.
So I agree with everything you said. How about that as an answer? I think discipline is the word I tried to say. I mean, I think the markets will be more disciplined, but at some point when you have capital that's in your pocket and you have to deploy it, that supply-demand relationship will be a negative for the risk return in this marketplace. And I think the option is that, you know, fund managers give some capital back to allocators, and that takes some money out of the ILS market. Reinsurers will have to think about how they give money back to their shareholders as opposed to having to deploy it. So it'll be very fascinating to watch those relationships and sort of how they, you know, develop. And one, you know, we could have an hour-long discussion about which market leads which market, right? So does reinsurance market lead ILS? Does ILS lead reinsurance? I think in different cycles you get different leaders, and so I don't think it's one answer fits every cycle. But as we get into the end of the year, it'll be interesting to see which market leads the other in terms of behavior.
Great. Well, on that note, I think we'll draw this to a close. Thank you very much, Paul Schultz.
Thank you.